Well, good morning, everybody. This is Andrew Horowitz, and this is TriggerCharts pre-market rundown for, what are we on? Friday, August 23rd, 2019. We're going to be talking about a lot of things related to the markets today because a lot of movement going on, a lot of things happening with regard to tariffs, and all of a sudden we have a new round of tariffs, once again, by China now coming in, scheduled for both, what do we have here? On September 1st is going to be something, and now on December 15th. So there's a lot of things happening there. I'm going to get right to our screen and look at that. And let's take a look at this. We're going to take a look at, here we go. Hopefully you can see my screen now and see what's going on. And let me just get a few things up on my screen here. And we should get going. Okay, everybody can hear me okay? You can chat back over in the little chat area there on your box down below. You see that? And make sure that you are hearing me okay. This is interactive. Make sure that you provide me with some of your stocks, some of the things that you want to talk about as well, because this is a discussion that is going to be both some things I want to talk to you about as well as some of your stocks. All right, so we got a good amount of people here today. The audience keeps on growing. Don't forget that, of course, this will be recorded. You can see this over on the YouTube channel for TriggerCharts or over on TriggerCharts.com. A couple of housekeeping items that I want to talk about first before we get going. Of course, this is important to note. This is for educational purposes only. Make sure that you understand that we are not giving recommendations. We're not giving ideas. We're not telling you what to trade. We're giving you education in the area of technical analysis and markets and all those things that are going on in the world of finance. So there's a quick disclosure on the right-hand side of the page here. So you can check that out. And let's get going and talk about what's happening. Well, now that you've seen this, we are bouncing around like a Super Bowl. Remember those balls you had as a kid where you bounce it and it kind of just starts going all over the place? That little ball, it was shiny. It was kind of sometimes different colors, clear, not the round ones that you play jacks with. I'm talking about those super compressed rubber balls or plasticky rubber balls that you bounce it and just starts hitting the walls and hitting the ceiling and going all over the place. That seems to be going on with the markets because it is a very headline-driven market. Right now, we are seeing a significant amount of just headlines just really wrecking. It's like a wrecking ball, and then it's like a crane building things up. I mean, we have both going on all at once. Pretty intense, pretty amazing, and we haven't seen anything like this that I recall since probably the last time was probably 2008, 2009, and the reason is we have the 800-pound gorilla constantly involved in what's going on. We have the government that seems to be wanting to get in on the action and talk about things. The Fed is constantly talking about one thing or another. This week, in fact, is a big week because we've had the Fed speakers, all of them come into play, well, many of them come into play at the Jackson Hole, Wyoming economic confab. It's going on right now. As a matter of fact, at 10 o'clock this morning, Jerome Powell, the Fed chair, is going to be speaking, and who knows what he's going to say. So with what's going on right now in terms of an election cycle and getting closer, discussions and tweets about, well, maybe we'll have some tax relief in the form of payroll tax deduction. Well, maybe we're going to do something in terms of lowering rates from the Fed. Maybe we're going to have tariffs. Maybe we're going to have a deal. Maybe we're going to start charging Mexico for tomatoes. Maybe we're going to putting tariffs on Europe for automobiles. I mean, it's just on and on. And they keep on going back and forth, setting up these trial balloons and trying to, I guess, incite a rally as best as possible while holding it back and at the same time getting better deals for the U.S. It's, well, exhausting. Markets are getting a little bit exhausted as well. Where are we right now? Let's take a look. The Dow futures are down about 120. The SPOOs are down 13. NASDAQ futures are down about 48. And that is a major turnaround after the news hit at about 8:02 this morning that China is going to have retaliatory tariffs of 10 to 15%, and there's some at 5% on autos. Some of them starting on September 15th, some of them starting on December 15th. Oh, excuse me. Some of them starting on September 1st, some of them starting on December 15th. That lines up pretty well with what we see is going on with what we said we are going to propose to add to theirs. So we have these trade tensions that are coming and going. Things are looking better. Things are looking worse. Nothing's happening. Meetings happening. Meetings called off. Buying Greenland, not buying Greenland. It's really schizo. I mean, it really is it's an absolute crazy market condition. And on top of that, we have some earnings that have come out, which have pretty much elated markets over the last couple of days. Because one of the things that has been really pressing on the markets and sentiment has been the concern about the consumer. How is the consumer actually holding up? How is the consumer dealing with all this? How is the consumer dealing with this confusion? And the concern was, well, let's see what happens with retail sales. Let's see what happens with the earnings from some of the major retailers out there. And we've seen a bit of a hit or miss. Last week, we saw that Macy's really didn't do well. Let's just say that. Their stock hit a 52-week and I think a 10-year low on Macy's. And then we started to get some other information from companies like Dillard's, and we saw Nordstrom's come out, Dick's come out, Gap. We're going to talk about some of those and look at those charts today as well. But if you remember last week, we talked about this whole idea that there was this, let me move some things around here so I can properly look at this. Last week, we talked about this whole idea that XRT, remember this? We had this chart up, this monthly long-term chart on XRT, which is the S&P retail ETF. And we looked at these three key bottoms right here. Look how we jumped 37.78 back up to about, where are we now? 39.51. About an 8% move in the last probably week or so. And that's pretty significant, as we saw that a few companies did a lot better than expected. Remember something, and I think it's really important to remember this, that there was a significant amount of short interest. There was a lot of concern that these companies were simply going to go out of business. So what you had here was a bounce up from this level on the fact that, well, things aren't as bad as maybe a lot of people think they are. Maybe they're clearing inventories. Maybe they got in on the tariff prices before the tariffs hit, and therefore were able to hold their pricing pretty well and profit at the same time. So we saw this XRT bounce up, really interesting level. We saw the support from the altimeter a little bit above where it was. And we saw that big leg down, that candle with a big wick on the right-hand side of this start moving down again into that in the beginning of the month and pop right back up. So retail looks like it's, well, it's not necessarily dead, but it is not necessarily doing anything really great either. So we saw that, and we'll talk a little bit about that. Major economic news of this week. Well, light week this week for economic indicators. Flash manufacturing PMI did cut below the 50 level. The level of 50 is a demarcation line between expansion and contraction. Important to look at, because when we look at this number, we want to see what's happening in our factories and service index. There is another one, the ISM index, which is the official index that comes out. Right now, what we're looking at is the flash index from market, and it did come below 50, showing us that we are potentially looking at a manufacturing recession. And you've heard a lot about this. You've been watching the news, listening to a lot of the media. They're talking about a manufacturing recession, and possibly not a recession in the area of healthcare, technology, maybe even some retail. I will share with you that if we do see that there is a rollover of this manufacturing, you're going to see it in retail as well. One of the things that's going to happen is if factory orders slow down, and one of the things you have to realize is factory orders, a lot of them are benefited from retail, right? When people are buying, clearing inventory, the retailers have to go out, get more products, manufacturers kick up the production. If manufacturing is slowing down, that does tell us that retail is slowing down as well. However, there is a caveat. In this market environment, one of the things that we did see was that we had a significant pull forward effect due to the fact that a lot of factories were manufacturing, getting goods in from other places, building up their inventories because they want to get ahead of the tariffs. This is going back 6 months, 8 months. So when they want to get ahead of these tariffs, what happened? Well, what they did was they really started producing a lot more, built up their inventories. And right now what we're seeing is that slowdown that was projected about 6 months ago. I thought it was going to happen in the first quarter. So it's happening in the second and third quarter, a little bit off on the prediction of when it's going to happen, because they probably started to really ramp it up very substantially, a lot more than anticipated, because they thought it was going to be a prolonged potential for a trade war or skirmish or kerfuffle or disagreement, whatever you want to call it. It's a trade war, folks. Don't you all agree with that? We're in a trade war. So right now, when we look at this, we have to realize that we're in the second half of this process, which is a slowdown of the manufacturing and a potential slowdown in consumption overall. And that's where things are going to get a little bit dicey. We did see that again, this 5 to 10% tariffs on the remaining $75 billion worth of U.S. exports are going to be hitting on September 1st and December 15th. And there's going to be particularly heavy tariffs or increased tariffs on automobiles and a few other products that are brought into China. Of course, that may or may not hold, dependent on what happens with regard to the U.S. side of things. If we do strike a deal miraculously, which doesn't look like we're any closer to a deal than we were 18 months ago. And remember, China plays the long game here. They're in a lot of pain already. They don't really care about maybe having some more pain moving forward. And what are they going to do with that? Well, what they're going to do is they're going to look at potentially holding off of any changes and any deal until after the election when they find out what happens, hoping that maybe Trump will be unseated and someone who's a little bit more friendly for tariffs and for global trade will step in. Europe, the negative yield curve dominates. We're seeing that really hit hard, and the negative yielding debt around the world keeps on growing and growing and growing. 17 trillion is the latest number of negative yielding debt. $1 trillion of corporate debt that is negative yielding. Now, anybody's going to tell me that this is normal, we're going to have a discussion. Something is not right here. Something is really wrong, in fact. And while we're seeing a lot of people make a lot of excuses for, well, you know, the yield curve is this, but it's only because of that, and it's really not something that we have to worry about, I don't think so. These excuses are made in times when things are just not right, and it's not right now. And we have to realize that, recognize that, and be ready. As I mentioned, we have the Jackson Hole economic confab going on right now. Moving the markets this week, we had ECB stimulus, we had trade talks, and the Fed minutes. The Fed minutes came out. Two dissenters, this was yesterday at 2 o'clock, two dissenters came out saying that they don't understand why we have any need to reduce rates. A few people were mixed about it. They felt markets pushed them into doing so. Negative, or actually the inverted yield curve was something that they were really concerned about, and that's one of the reasons they moved it. Next week, we have coming out a lot more durable goods spending, Shiller home price index, consumer confidence is going to be coming out on Tuesday. And then we get into GDP, the second revision, which it looks like right about 2%, maybe 1.8 to 2.1%, depending on how things are calculated. Personal income and spending. And we're going to have PCE expenditures as well at the end of next week. Now, oftentimes, this is a sign. Remember, when you see durable goods, Shiller home price index, and the consumer confidence and Shiller on a Tuesday, oftentimes, remember, that's getting in towards the end of the month. There's a lot of window dressing that goes on, and you have to look for market bounces in a direction either way that may be just done because of cleaning up the books on a monthly, more importantly, on a quarterly basis. We're only coming into the end of the month at this point. Take a quick check on futures here, down 140 on the YM. They were up about 100 earlier, so that's about a 240-point move to the downside. ES down 15. NASDAQ's down about 59 right now. A couple things I want to mention to you. I'm going to put this in the chat here. If you haven't done so already, there is a 10-day free trial for all of the TriggerCharts indicators over on the TradeStation Trading App Store. Folks, let me just tell you, if you haven't done so already, this is something that could really enhance your trading. And if, in fact, you are a new subscriber to the Commander Series, we'll give you a four-hour course that gives you a lot of the background, a lot of the integral components of what goes into a market profile, what goes into altimeter, all of this that is done. It's a evergreen piece that we did some time ago, but it is yours. And it's I think it's $129 or $99 value. It's about $100 value that we usually charge for it. But anybody that does in fact sign up for that, just email us at info@triggercharts.com, and you can check out all of those over there. All right, we're going to be looking at some of the retail in particular this today. We have the Buckle, we have Target, we have Lowe's and BJ's, and we have last night after the close, we saw that Salesforce came out with a number, really nice number, Intuit, Foot Locker, HP, and The Gap. Before we do that, let's take a look at something here. I want to switch over. If you remember, I talk about this quite often when I want to look at what's happening with market trend. There's two things. I like to look at trending indicators and some that have a statistical measurement in them, the McClellan oscillator. I also like to look at the Spearman indicator. And this is the McClellan oscillator on the left-hand side of the screen. So what you're seeing here is that we did see a nice little move to the bottom, which was a signal of sorts. These bottom levels are oversold, significant signals, and they did, in fact, resolve a little bit better to the upside. Right now, we're at a plus 35. Right now, we're seeing a complex staying over the zero line, at least for right now, in a nice way. That is possibly a restart for a new rally situation, setting up for an uptrend, but we did see a lot of very significant damage done on the downside here, and it still is something that needs to be proven. As my good friend Brian Shannon always says, the market is guilty until proven innocent, I guess, right? So you have to remember that we are looking at, this breakdown and this real ugly looking situation that we saw here, and at the same time realizing that with that in mind, we have to see a really good level of upside action holding above the zero line on this McClellan oscillator, in my opinion, at least to see the opportunity for this to move back up. This is the New York Stock Exchange composite right here. We want to see that move back up if we can see some continuation. But again, it's been this bouncy back and forth escalator type of movement of the markets. The Spearman did get off the low pretty much at the same time the McClellan did. So you got these levels right about here in the beginning of August. Same thing here, did turn up. It is above the zero line, and that's good, moving up to the top level here. So you got some confirmation that's a little bit of a bullish situation for markets, excluding the fact that, of course, we have Fed speakers and we have tariff issues. So all bets are off on this because it can come from left field at any given time, what's going on. As a matter of fact, I had a discussion just this week from someone from IBD, the head of content over at IBD. And we talked about the fact that these left field moves of tariffs or tax issues or rate cuts or governmental issues are really starting to mess with markets' heads, and it's a real big problem. I also want to look at this, which is the key reversal indicator. Market currently in equilibrium. We see once again in the beginning of August, pretty much on key with the Spearman and the McClellan oscillator. You saw that there was a green dot there. That green dot is really important. What that really signifies is that there was a cluster formation there. And when you see those are possible turning points. And again, we always look at this one here, which was the key one back in the end of 2018. This was a good one as well, but there was a key reversal right there. This is a really inexpensive indicator that you can get over on the trading app store. It does one thing, it does one thing only. It takes one symbol and one symbol only. It looks at SPY. It looks at the big market condition, puts in a variety of psychological indicators in there. You can't change the symbol on this. It's only SPY. What you want to use this is for big picture trends. Where are we right now? We're leaning on average to the downside. You see the bottom part of this here is it's green. Green is kind of in this way is oversold. Red is overbought, and a variant and gradient in between. What you're seeing here is that we're leaning towards the negative side here. It's not like this nice uptrend that we saw here, even though it got a little hot, where you could say that, hey, things are really good. Right now, we're seeing this kind of downtrend, just like we saw here. Not really good till you get consistent and consecutive over the zero mark. We haven't gotten over the zero mark to really indicate a new rally potential that I see, at least. Like I said, put in your charts. I'm going to write in here so you can see it. Put in your symbols right there. Let's take a look at where we are here. 131, kind of holding at these levels right now on the markets. So that's good. Let's go and take a look at some of the stocks that I loaded up here. Well, I want to look at a couple of things first. Let's look at TLT. TLT is the iShares 20-year Treasury ETF, which is representative of long bonds. And long bonds have been doing pretty well. We see that they had that big move in August, obviously, as rates came down very significantly with the thought that the Fed was going to continue on their way of possibly consecutive rate cuts into the end of the year. As a matter of fact, right now, I think that there's anticipated to be about 2 more rate cuts by the end of this year. But we did see that rocket ship move up very significantly, and it right now consolidating. We'll see what happens from here, but this is, if it was a stock chart, you would like this. You would say, hey, I like that chart. It looks pretty good. So whether or not it is stocks or bonds, and this is a bond ETF right here, it does look like there is a pattern that could continue to the upside on bonds moving forward. The buckle, these are kind of, on the left-hand side, you're seeing the 60-minute chart. On the right-hand side, you're seeing the daily chart. And the buckle has been in, I would say, let's move this back a little bit. It's in purgatory for some time. It was in July of last year, upwards of 28, currently trading at 1962. That's with a 5.5% increase in the pre-market. So it's trading right now up to its resistance line right there. Look at that. What a miracle. 1995 is its resistance when you look from right to left, and we draw things like, for example, if we just draw a simple line across here, right about here, we connect a few different dots. We're talking about 1987 is the number, and we're stopping right now at about 1962 after the earnings. So it looks like there's conviction. If there's going to be follow-through is another discussion entirely. Use your drawing tools as much as you can. Target, wow, did you see that one? Look at that. That's an amazing chart. All-time high on Target. And look at that, going back some time. We did this on a weekly basis. Let's kind of bring this to weekly. Sometimes I like to stretch this out. Look at that. So what happened here is, if we look back, we did, of course, have earnings that were pretty impressive this week. I use daily only for the educational purposes. You can use any particular time period that you want on this. But what was interesting is, hey, you want to see something really cool? Right here. You see that? Right here. When the stock was 83.94. That's when a long was called right there on the 18th. I believe it was the 18th, looks like, of this month. You would have got in on that, a very easy call, because what else do you see here? Well, what we see in this particular circumstance is that if we back this up a little bit, we see that there was a very long and a very important level of consolidation that we had to get above. It goes back from August all the way through June. Getting above that point was the opportunity for this thing to really ramp. Well, of course, it opened up, gapped up a lot higher. So there was this opportunity. There was a lot of congestion here. Now, their earnings were really good, and things were really impressive when it came out to their forward look and their guidance, their traffic, same-store sales. But when you look at this, and when we saw this, that there was this great opportunity here, you may say, well, there's all this congestion here. This was called very nicely, and we have what I like to look at as tight levels of the altimeter. The altimeter is the three lines. You got is the green, the cyan, and you got the red. And that's the altimeter. See how tight that is compared to this one here? I mean, look at the differential when we look at the altimeter, and we see, for example, when we're looking at a range, how wide that is versus the differential and how wide this is. See how tight that is? And even when we look at how tight the last one was. So we look at this and we see, well, we're finding that there's tight levels after some larger levels, after some gapping work that was done. This all looks to be like there was opportunity for an upside move. We compressed down the levels that was going back and forth, up and down. There was general price agreement when it came to the stock. And when it did blast off, it blasted off. So always look for when we have these wide levels, so maybe some gaps in the past, and then what you see for moving forward is tight, very compressed, very thin, very tight lines. And those are levels that you want to find. If you do get past that, it is an opportunity to get into a stock. So there you go. Let's see if I can seemingly remove drawing objects. You ever do that? You just kind of say select all, okay, and they're gone. What do we got next? Lowe's. Lowe's, another good one. It is a little bit of a different pattern here. There's a lot of congestion up to the top here on Lowe's. A lot of things going on, but it did have a nice gap up because it did do well in earnings. Home Depot also had a pretty good earnings number. That was really good. But where are we now? So we're sitting right now at about 107 and change. Where are we at? 107.09. So right about here, where we have some support, you can kind of draw that line once again, moving across. Very simple. Grab your line tool, just go down your list, and you got some boxes, you got arrows, you got all this. You grab your other one, grab your line tool, kind of draw it across, and you can see that there's a lot of connection right about this 105.99, which is probably actually a little bit higher than that. Let me go a little bit higher. Right there. 106.26 is probably your level that you want to look at as interim support. Then probably back down to, I would say, right about in between here, 104.85. The continuation, I'll just continue using this line for you. If we do see this pop back up, of course, if you just look at, we just grab a couple of lines across, pretty much where it ended up. Look at that, right at that line right there. No magic here. All you have to do is draw lines and understand colors. That's how, I like it simple. All you have to do is draw lines, draw boxes, look from right, look to left, understand what's the long-term trend. We look up here, what's the long-term trend, what's the long-term trend, and you kind of look at it that way. We see this turning around, obviously, from a long-term trend of a short alert that we saw on the weekly basis, and now turning into a long alert on the longer term. BJ's had a nice day yesterday. Do we see anything here? This is kind of a newer stock, but BJ's, once again, look at that. It went right to its level. Just going to take a simple drawing and mark it right there. Look at that. We saw that line that we intersected with. It has, I would say, a pretty good opportunity to move up to its gap. That would be the line that I would look at, about $27 for a level of profit taking on that. Backing up a little bit, where could it go? Probably into this range. Right about here where we have some really good. Blue is a real good support level. The cyan is an important level. Kind of moving along, we saw CRM get a decent number, up about 6% in the pre-markets after a major drop down. There's some concern about their numbers with regard to some of the acquisitions they did recently. CRM is currently trading at about 157, right in the middle of this range right here. Let's kind of skip over to Foot Locker. Foot Locker looks awful, and it looks awful. Down about 12.5% in the pre-market after the earnings came out, trading at about 36. That's off my chart, somewhere down here. I saw that an overbought situation occurred, but generally speaking, when you go from a oversold level on the aileron, okay, so the momentum was oversold, then all of a sudden a big tick up, and that was due to the other retailers that came out. You got to be a little bit concerned. There was really never a good level of commitment on the upside for an uptrend and a good rally all the way back to May that I'm looking at right here. The Gap came out with earnings today. Gap is gapping down today, down 4.5%. And we're seeing it right now traded right at the $17 level, which is right about here in no man's land. You'd expect to see this back down to about the $15.60 level if it could even hold that at this point. This is an interesting stock because I liked how it fell off a cliff right here, and it's now trading inside this range. One of the things that's really important is you'll notice only two lines. We have a cyan here, right? You only see a cyan, and so right here, and you see a red. Where's the green? Where's the bottom? Where's that support level? It's hidden. Where is it? Well, it's hidden. It's hidden back right behind here. If you hover over this line, you'll see that the lift and the stall, the bottom right, if you can see that, I'll bring it up a little bit. 1397, both numbers. What's important about that is that we have a level of support that was very consistent and held for a while, jumped from about 1397 up to about 1918. Now it's rotating down. There was some issue about their earnings and outlook. So a lot of people jumped on this because it was a $35 stock. And even before that, look at this, it was a $70 stock, gapped. Is it going to fill this gap? You got to watch this. I would keep this on your radar to see if something happens over about 1982 on that. And then we talked about XRT. We have about a minute left. Talk about this XRT. Let's take a look at where we are on here. 118 down to 12. So let's kick you back a little bit here. We talked about XRT a little bit here, and let's clear all these. XRT coming up to its level of resistance at this green. Always look from right to left. So that's about it, gang. I'm going to mention to you also, again, please do us a favor. We are the #1 rated overall indicator, the Commander Series. We have a lot of them, but the Commander Series indicators, which you're looking at right here, is the #1 rated in the trading app store. And for that, I thank you. And make sure that you tell everybody to join us on Fridays. You can check it out over on our TriggerCharts YouTube channel, or replays are available with the notes and notes on what we talked about, the stocks we talked about, over on TriggerCharts.com. So thanks so much for joining me today, and I'll see you again next week. Thanks again. Appreciate it.